Hey guys, welcome back. In today's video, we are talking about the huge AMC opportunity, the short squeeze hint, the system collapse, and many more in this video. First, we're taking a look at this. Disney has a massive hit on its hand with Zootopia 2, which has secured an enormous 556 million global opening at the box office. So we already knew that Zootopia 2 has done extremely well, and this is how well it's doing. Now, the reason why I want to talk about this is because of the market in which it's doing well at. I'm not sure everyone has yet comprehended what's happening with Zootopia 2 and soon Avatar in China. Disney is making more money there on Zootopia than in the domestic box office. As US films find open screens in China, the profit models become far more lucrative. And now the bottom line is that if studios are cracking open Chinese doors, theatrical profits become far easier to achieve, which in turn means more movies will be released, helping US exhibitors. So this is what we are looking at in terms of how well Zootopia is doing in the Chinese market. Now, we have already talked about this beforehand, but this really just strengthens what we have been saying. And this is an indication of what's to come as well. In the future, as we see more and more movies being released, we know that there's also another market that's extremely big. And so if you wanted any other means of knowing whether or not the industry can grow, well, here it is. It's of course looking at the Chinese market. Now, this has got to do with AMC as well. We knew that previously there was a Chinese company that had a stake in AMC. And we've known that also, along with US exhibitors, is that AMC has their own film distribution. I want to talk more about this later on as well, but it's talking about how we are still able to profit from this very market. Now, this is already something that's helping AMC. The fact that there are more films that's going to be released and that helps the US exhibitors, that will benefit AMC. But on top of this is the fact that we can also benefit from this market with the film distribution, obviously in the future. And now I want to talk about this here. So you can see, ignore AMC stock in 2026 and load up on this movie theater stock instead. So this is from the Motley Fool, and it's a negative news article on AMC. Now, as always, we are not surprised. But as always, we've always said, you should take each article seriously because there could be points there that we can take. However, with this article, I think that it is extremely stupid. And the reason why I say that is because the things that they mention in here are things that are not actually what's hindering AMC. So firstly, one of the things they talked about is the movie theater business has been challenged by the massive expansion of video streaming platforms. So here's talking about how AMC is being affected by video streaming platforms. And we said this in yesterday's video as well. We've seen plenty of people talk about how AMC is going to go bankrupt because Netflix is growing, because Netflix is going to take over. Yet, what we also said was the fact that we are seeing Netflix seeking out collaborations with AMC. So the fact that they're saying that these streaming platforms are expanding, yet they're collaborating with AMC, should already show you how what the point that they've made here is extremely contradicting. Now, what's also need to be understood is the fact that on top of this, we have already seen how films have talked about being released in actual theaters as opposed to video streaming platforms, and we've seen a difference between the two of them. Secondly, they talk about AMC carries significant debt. Now, we've already said that these articles continuously talk about the AMC debt, yet what they fail to say is how AMC is paying it off, how AMC is restructuring it, how AMC is seeing a lower and decrease in interest payments. You know, once again, they never mention that part. They only mention the debt area, and that is something that needs to be talked about before, you know, anyone gets into this debt problem, because as far as we can talk about, as far as we can see, yes, there is originally a problem. However, AMC is solving it, and these news articles never talk about the actual part of solving it. They only talk about the existence of this debt. And so the company they wanted to talk about in comparison, in terms of ignoring AMC stock, despite the fact they talked about streaming platform, they still want you to invest in this industry, but they want you to invest into Cinemark. Now, the comparison they made was how AMC have continued to disappoint. As of December 1st, they were down by more than 41% this year. So these are the points that they are trying to make. Now, bear in mind that Cinemark today actually went down 9.35%. whereas AMC only 0.87%. So they said that in this year, as of December 1st, AMC is down 41%. Cinemark in one day has covered a fourth of what AMC did in a whole year. Now, we've already talked about the manipulation that's going on behind AMC. We talked about the comparison between the dark pool usage between AMC and between Cinemark. This isn't just me saying that AMC is getting manipulated and Cinemark not because I'm an ape, but this is talking about actual data which has shown the difference in dark pool usage between AMC and Cinemark, the difference in FTDs between AMC and Cinemark, the difference between the tokenizations of AMC and Cinemark. There are so many factors that you can see and use to realize that AMC is being manipulated, Cinemark's not. Yet, today, Cinemark went down 9.35%, almost a fourth of the 41% that AMC saw this year. Now, that's something that they're obviously not talking about. They're just focusing on AMC. And what we also have to realize, and this is something I want to talk about earlier, is whilst they're trying to say that these video streaming platforms are going to take over, we can see this as well. Netflix is now actively exploring the possibility of buying Warner Bros. And so this is something that we are seeing. Now, definitely, yes, they are expanding. And the fact that these streaming platforms are wanting to buy these film distributors should already be a massive indication of the potential that they see. We've seen how these movies being released on Netflix are not actually doing as well as they would have done had they been released in theaters. And this is why we're seeing them expand. So this is not a Netflix is expanding into the video streaming platform industry and therefore is taking shares of the movie industry, but rather is that Netflix want to expand into the movie industry. There is a massive difference, but they're trying to say that the whole movie industry is going away because of these video streaming platforms. But the reason why I want to talk about this more is because of the fact that Netflix sees the opportunity in film distribution. What we talked about earlier was how Disney had a massive hit with Zootopia 2. We talked about the Chinese market as well. And then when you understand all of this, when you understand that this is all about movies, we realize that AMC also has AMC film distribution. Yes, it's not something that is major right now, but definitely with the opportunity that's arising right now, you can expect how AMC would want to expand into that as well. So we know that there are more and more opportunities coming out for movies right now. We know that there are more markets that are emerging. And so with this in mind, the very fact that AMC is then able to have a film distribution market and is able to release films which potentially, and now this is something that we don't obviously know for sure, but if they were to also get a hit, imagine if AMC were to release something of a movies along the lines of Zootopia 2 with the mind that they are able to see a 556 million global opening, right? When AMC is able to do that, that's when you'll realize how much potential there is. And these articles, once again, are failing to say that. You can see the things that they are focusing on are just things that is contradicting. They're talking about challenged by massive expansion of video streaming platforms, aka Netflix, who asked to collaborate with AMC. They talk about the significant debt. What they fail to talk about is how AMC is paying off the debt. They're talking about Cinemark, and they're talking about how AMC is down 41% this year. Yet it fails to say that Cinemark went down 9.35, which is almost a fourth of what AMC did in a year. So there are so many things that they're just failing to talk about and that they don't want to say because they don't want you to know the true potential of AMC. Another big thing, which is the short squeeze hint, and this is something I want to talk about, is why did Michael Burry not crop the AMC out of his profile banner and left it? It doesn't seem to be the clumsy. I firmly believe there's a reason for it to be AMC. So anyone can go check this out. As of right now, Michael Burry still has this as his banner. And you can see at the very corner, he has the AMC chart. Now, what I find the most interesting about this, and what if you guys can't see this clearly, you guys can obviously go check it out on his Twitter as well. But it's the fact that it's the chart of AMC in which he cropped for the all-time high when we saw how AMC was a panic pressure for the short sellers, and it created this high of a price. But then it has a red arrow pointing at that price. Now, this may be me just going over analyzing and thinking too deeply about this, but it's the fact that he not only has a chart of AMC, but it was AMC at its peak and also a red arrow pointing at that price, especially with what he has been talking about recently. And you can even see here on why he stopped managing his fund is that he thinks that the stock market could be in for a number of bad years. I think that we're in a bad situation in the stock market. I think the stock market could be in for a number of bad years. And because of him saying that, and because of this particular arrow, is leading me to believe, along with what he's been saying about GME, is that he obviously thinks that there is a squeeze happening. We've talked about the collaterals. We've seen him short Palantir. We've seen him short NVIDIA. We talked about the correlation between NVIDIA and AMC. We see him then talk about GME and its course of action. We now see him pointing an arrow at the AMC's high price. All of this is really making me believe that he thinks there is a squeeze, and he's hinting at all of this. Once again, it could just be me over analyzing. I'm curious to what you guys think, but I feel like there is a sort of connection between everything that he's doing. And when you look at it further in terms of what's happening in the economy, you can see banks, we need 22 billion in liquidity ASAP, or the global financial system will collapse. The CFTC, say no more, fam. As we see that they announced to unlock over $22 billion of collaterals. Once again, keyword here being collaterals. And this is why we talked about the importance of it. And the very fact they need another 22 billion should show you the lack of liquidity that's in the current market. And we talked about how this is forcing margin on many, many institutions already. But it doesn't stop there, because that's not even close to what they need to close GME and AMC swaps. What is coming will be worse than 08. Now, the reason why I say this is because recently we talked about how NVIDIA falling has allowed AMC to go up, and that was due to the lack of collaterals. And now, as we talk about this, we're seeing them injecting more value, more collaterals, more capital into the market. Is making us believe that that's what's allowing them to keep it afloat right now. It feels like they are just trying to fill the hole that they've dug with these money. But one thing we've realized is that no matter how much money they seem to inject into the system, the problem still remains. So we know that 22 billion is not enough. They will need so much more for what's actually happening. Because you can take a look at multiple firms, especially when you take a look at UBS, how much money they've been required, and yet it still doesn't fix the problem they're in. Another case, liquidity across financial market is becoming increasingly scarce. Bank usage of the Fed standing repo facility hits 26 billion on Monday, the second highest since the 2020 crisis. So we are now facing a problem that we once faced back in 2020. And this was where everything was obviously selling, where everyone was panicking because of COVID, because of what's going on. And now, right now, with nothing actually happening, we're not seeing a pandemic, we're not seeing any crisis, yet we're seeing signs as if we're looking at a pandemic, as if we're looking at a crisis. It should show you how bad the problem is getting. If you want to take a look at the reverse repo, 2.5 billion. However, when you take a look at the participant counterparties, we have 40. So we have 40 counterparties fighting for 2.5 billion. And that itself should show you that some of these small firms are seemingly struggling right now, and that we could be looking at them really panicking. And the talk of a margin call for an institution, for a bank, may be closing upon us. And this is obviously what's worrying. This is why we're seeing earlier in terms of why CFTC is unlocking $22 billion of collaterals, is why we're looking at, the second highest since the 2020 crisis, because of everything that is going on. And then on top of this, hedge funds double down using near record leverage in quest to boost returns. So the reason why this is extremely worrying is because this isn't something that is natural. They are doubling down. They're using record leverage to boost returns. The reason why I say this is ridiculous is because they are putting money into the system, and then they're making money off of the money that they put in. There is no actual value that is being created. If you want to take a look at this, first, we already seen the SEC warning to fund managers is for ETFs at 2x or greater returns, where they need to prove that they're being compliant with Rule 18F4, which requires a value at risk of less than 200%. The very fact that they need to talk about this and you mix this up with the fact that they're using record leverage should show you what's going on. It doesn't look like that they are using leverage to maximize returns, but rather they're using record leverage to actually make the market look like it's going well, because we know we talked about inflated and artificial value, because we looked at this article. Nvidia CFO admits the $100 billion OpenAI mega deal still isn't signed 2 months after it helped fuel an AI rally. So for those of you who don't know, when Nvidia first talked about this deal, this $100 billion OpenAI deal, it boosted the market. We saw how everyone surged. We saw how big of an impact it had on the AI market. And we talked about how that already was inflated because a $100 billion deal managed to put in over $1 trillion worth of value. But what's worrying about that is that that deal isn't actually finalized. That deal isn't actually existing. It's just word of mouth. It is just something they've said and it hasn't actually been signed. And so if you want to look at artificial value, if you want to look at value that shouldn't exist, these are all examples of it. And when we take a further look at the fairness of the market, you can see SEC fines Virtue 2.5 million for not safeguarding customers' information for more than a year. So not only do we have artificial value, like we talked about, whether it's doubling down, whether it's having a value at risk of less than 2%, whether it's the talk of artificial deals. These are all signs of markets not going well. And then on top of that, you have the fact that you have these market makers not safeguarding customers' information. And I think the boss Blunt here has put it out very, very nicely here. The stock market has always been the #1 way for the middle class to achieve financial independence. But that's nearly impossible now due to market manipulation. 81% of all AMC stock was manipulated in dark pools today. So we talked about this earlier. The reason why we're not seeing actual value for AMC is because of dark pool. Compare the off exchange value for AMC in comparison to Cinemark today or any time, and you'll know why we talk about why it isn't fair. But it's the fact that this was a market that has always allowed the middle class to achieve financial independence, yet we're seeing these problems, wherever it's not safeguarding or wherever it's artificial value. As always, none of this ever financial advice, so do take a grain of salt. Make sure you do your own due diligence and research, and I'll catch you guys next time.